All right, let's dive right into this explainer. Today, we're demystifying a tool that's absolutely vital for the survival and really the growth of complex businesses. We're talking about the 13-week cash flow forecast. Specifically, we're going to look at how this framework helps pharmaceutical manufacturers and private equity-backed companies protect their liquidity, avoid those nasty cash surprises, and ultimately drive incredible enterprise value. If you're operating in a high working capital business, or honestly any environment with tight liquidity, consider this explainer your new roadmap.
Now, the single most important principle in cash forecasting comes down to a really hard truth. Revenue absolutely does not equal cash. Your accounting team might be throwing a party in the break room because a massive invoice was issued and revenue was recognized on May 1st. But frankly, in cash forecasting, we just don't care. We only care about the reality of when that customer actually pays us, say on June 18th. Sales forecasts alone are totally insufficient here. We are strictly tracking when the cold, hard cash actually hits the bank account.
Which brings us to a high-stakes question. When does the cash actually move? It matters right now because we have to definitively know if we can make payroll this Friday, or if we can pay those critical vendors to keep our supply chain moving, or maybe most importantly, if we're going to breach those strict liquidity thresholds set by our lenders. An accounting forecast simply won't tell you that. A cash forecast absolutely will.
So why exactly 13 weeks? It's not just some arbitrary number picked out of a hat. 13 weeks is the gold standard. It's heavily relied upon by private equity firms, corporate lenders, and turnaround consultants for a very good reason. Monthly forecasting is simply too slow to catch a liquidity crisis. And annual budgeting? Well, that's way too static to be useful in daily operations.
13 weeks happens to be exactly one fiscal quarter, which makes it the ultimate forecasting sweet spot. It's short enough that we can achieve real operational accuracy, but long enough that if we spot a massive cash shortfall in, say, week 9, we actually have time to act on it today. It operates as a short-term rolling liquidity forecast, meaning every single week, week 1 drops off into history and a brand new week 13 is added to the horizon. It's a continuous rolling window.
At its core, your forecast is built on two main movements. On the inflow side, customer collections represent your absolute largest source of cash, maybe occasionally supplemented by things like tax refunds. On the outflow side, you've got your disbursements. Payroll almost always stands out as the largest, most sensitive weekly outflow, right alongside your critical vendor payments and strict debt obligations. Let's break these down, starting with where the battle is usually won or lost: collections.
Winning the collections game requires modeling actual human behavior. You can't just naively assume invoices are going to be paid exactly on their stated terms. Weak forecasting looks at a net 30 invoice and just assumes the cash magically arrives on day 30. Strong forecasting, on the other hand, looks at that same invoice, knows the customer chronically forgets to hit send until they get an angry phone call, and strategically schedules that cash for day 35. You're modeling reality here, not the contract.
Best practice actually dictates tracking these collections at a granular customer level. Take Pfizer, for example. We've got $2 million slated for week 3, and because of their pristine payment history and the fact that there are no missing purchase orders, our confidence is high. But then, look at client C. We have $250,000 sitting there, the payment date is totally unknown, and our confidence is low. This forces your accounts receivable team to step up and ask the hard questions. Is the invoice disputed? Is a shipment missing? We really need to evaluate these specific statuses to figure out our true confidence in getting paid.
Once you understand that human behavior, you can start applying the math. Let's take a $1 million invoice. Instead of just dropping the whole million into the forecast and crossing your fingers, we assign it an 80% probability based on aging trends and customer history. Because of that, we're forecasting a much more realistic $800,000 in actual cash for that week. Doing this prevents some seriously dangerous over-optimism in your liquidity planning.
Now, you can't just hoard cash and refuse to pay anyone, right? You have to strategically forecast your outflows to balance your own liquidity while still prioritizing critical partners. If you're a pharmaceutical CDMO, for example, you absolutely must prioritize your active pharmaceutical ingredient, or API suppliers, as well as your specialized packaging and logistics providers. If those relationships break down, your production grinds to a halt and your cash engine dies entirely.
And let's be honest, manufacturing environments are inherently messy. Your payment and collection forecasts really have to account for the harsh realities of the factory floor. Things like batch failures, delayed production, or sudden raw material shortages will absolutely destroy your liquidity if you aren't prepared for them.
Excess inventory is honestly one of the fastest ways to freeze up your cash. You've got to align your forecast with actual production schedules and demand realities to avoid these catastrophic traps.
You also need to carefully forecast your capital expenditures. In pharma, we're often talking about massive investments, things like building out new clean rooms or installing complex HVAC systems. And here is exactly where accounting will trick you. The cash goes out the door to pay the contractors today, even if your accounting team capitalizes the asset and amortizes the expense over the next 10 years. Remember, the 13-week forecast only cares about the cold, hard cash leaving your bank account right now.
Making all of this work requires extreme operational discipline. This is not a monthly task you do isolated in a silo. It has to be a rigorous weekly rhythm and involves gathering cross-functional data, updating the role, and most importantly, running a dedicated weekly cash meeting. That meeting needs to include everyone from FP&A and Treasury to procurement and operations. Cash is, fundamentally, a team sport.
The final and honestly perhaps most important step of that weekly rhythm is variance analysis. This is how you actually get better at forecasting. You have to relentlessly ask specific questions. Why did collections miss the mark by 10% this week? Why were those vendor payments accelerated? Why did payroll jump so much? Was it unexpected overtime or shift premiums? Constantly asking these questions improves your forecast accuracy metrics and significantly tightens your cash conversion cycle over time.
To answer those variance questions accurately, guessing is just not an option. You must integrate granular data sources directly into the forecast. If you're running an ERP like SAP, you need to be pulling from AR and AP aging reports, digging into the customer and vendor master files, and analyzing open purchase orders and inventory reports. You need hard operational data to fuel this engine.
While Excel still remains highly effective for ad hoc scenario modeling and formatting lender reporting, and honestly, it's where most companies still run their 13-week forecasts, the industry is evolving fast. Using Python libraries like Pandas and Scikit-learn, leading finance teams are starting to automate massive AR collection predictions, run anomaly detection, and perform complex liquidity simulations at literal lightning speed.
But the real magic happens when you leverage modern tools like Power BI to visualize all these complex data streams. You can take all that granular SAP data, the Python predictions, and your Excel scenarios and pull them into intuitive dashboards. This gives your executive management team and your PE sponsors real-time visibility into vendor exposure, overdue invoices, and daily liquidity trends, all without making them sift through a massive 100-row spreadsheet.
All of this brings us to the core philosophy of this entire explainer. The strongest finance teams completely abandon the illusion of accounting precision. They understand that a 13-week cash flow forecast is a highly proactive operational tool. When you break down the silos between procurement, operations, and finance, you create a level of predictability that inherently drives up the enterprise value of the whole company.
To wrap up this explainer, I want to leave you with a final, somewhat provocative thought to examine within your own organization. Look at your current forecasting process and ask yourself, is your cash forecast actually predicting reality so you can make strategic decisions today? Or is it just recording history after the damage is already done? Answer that honestly, and you'll know immediately if you're truly managing your liquidity or if you're just letting it manage you.